Good afternoon, everyone. Thank you for joining us. It's a pretty good crowd. This is Michael Golden from SES Advisors, and with me is Steve Greenapple.
Hi.
From SES Advisors. And
I'm with Steiker, Fisher, Edwards, and Greenapple, and with SES Advisors. Steiker, Fisher, Edwards, and Greenapple does the legal side of the ESOP transaction and process. SES Advisors does the financial analysis and record keeping.
And with that small introduction, we can come back and explain more about what we do, but most of you have a good sense from looking at the website, and we can talk about that later. What we're doing today is looking at how you structure an ESOP transaction for a company, how you think about it, how you go about setting it up, the issues that you have to take into account and how you do that as you're structuring a transaction. We're sort of doing this from the end product point of view, where all the analysis has been done and now the ESOP structure and of the transaction is being proposed or set up, and the backup information that demonstrates that it's a feasible transaction. Because this one, I hate to tell the end of the story, but this one is a feasible transaction. And so we'll go through that. And how do we?
If you have questions, there's a chat window. You can enter them in the chat window, and we will see them. We have one question pending already. Are the slides available for download after the presentation? Ordinarily, with almost all of our webinars, the answer is yes. In this case, because there's some proprietary information in there, we will not be making the exact slides available, but we will have a redacted version available shortly after the presentation.
Okay, so let's, I tell you. Okay, in this case, the equity value of the company is $25 million. You can see this is a 100% transaction. Some of it is senior debt, some is with the sellers taking back paper. Pretty much market rates that we're talking about, and typical seller security and typical senior debt security. In this case, this is a 20-year amortization. For the seller note, that's just to stretch things out to make sure that cash flow works in this particular case. This is sort of a conglomeration of various transactions, so it's not an actual transaction. But the 20-year amortization in this case is just to stretch it out, but there's a cash flow recapture and a deferral option so that if the company is doing well, it can prepay, and if it's not, the seller can hold off.
So, Michael, this is a ESOP transaction analysis presentation as you would submit it, or I should say it's portions of that presentation that are sort of typical of what you might present to a client after they've requested the analysis and provided you their data and information, and you've put together this analysis for them?
Yeah, absolutely. I mean, the due diligence list is substantial. It's almost as much as you would see for the transaction itself. You have to look in a lot of documentation about corporate structure and other issues that you don't really need from a financial structuring point of view, but you don't want to structure a transaction as if everything is just an Excel spreadsheet absented from the universe. So you've got to make sure that you hit on all the pieces that could prevent or make more difficult or instruct your structuring of the financing or other terms. But this is what we would normally, it's a redacted version of what we would typically give to a client at the end of the analysis that they've asked us to perform.
And how does what we're sharing with the audience here compare with the full-blown transaction analysis that you deliver to a client?
Well, there are some pieces that we've had to remove just because they are part of our proprietary model that we can't share. But in general, you're seeing most of what most of what a client would see. The numbers are all fictitious, and it's a deal mostly created for you all. So you're getting the flavor, you're getting most of the sense of the detail analysis pieces and how the model helps a client make a decision about whether it's a good idea for them, whether they want to do it a different way. But our job is to say, you know, if you want to do it, here's our best case scenario of how you might go about it.
Okay, thank you.
So seller note is going to be, in general, a lower interest rate because you've got the issue of the applicable federal rate. You don't want to have an estate issue. You don't want to have the regulators come in and say that you traded at a higher rate than is acceptable in the market. And in order to avoid all of those issues, you can keep the rate down to the applicable federal rate. One advantage of that to a seller is that they are then acting as sub-debt. Obviously, they're behind the senior debt position, and they are acting as sub-debt, so they have a reasonable expectation of a higher return than senior debt. Now, since they know much more about the company and its performance and projections than, say, a third-party mezzanine debt supplier might know, and for market reasons such as that, you don't get the kinds of returns that you would expect, you know, 17, 18, 19, whatever % for mezzanine debt. But you do get warrants as a mezz finance entity would also get. So what you do is you have your interest rate, which fits within the regulatory environment, and then you have warrants which get you up to a market rate return for this kind of transaction. In addition, typically a seller will want to reward management so that management stays, or key people, key technology people, however the business is structured and whatever is important. So they will create, as part of this, retention SARs. So stock appreciation rights that mimic equity positions, so that they reward management or other key personnel for staying with the company, making sure that it grows as it was projected, making sure that the sellers get repaid, making sure that the long-term sustainability of the organization is attended to. Anybody have any questions at this point? Okay, great. So here's how we structured the financing. In this, remember, we had a $14 million senior note, senior note, and a $11 million subordinated seller note. We have a 5-year term, 5% interest, kind of standard, typical senior debt. The seller note, in this case, we're making it 8 years. We've got the cash flow recapture, we've got the cash interest and warrants, and you'll see that some of it's interest only at first. What we want to do is get the senior debt started, get it out of the way, get cash flow up enough to cover, and then we can amortize so that the seller, in this case, has a set understanding that in 8 years they'll have received back their note principal.
Now, Michael, to sort of back up these conclusions, have you worked out the company's projected cash flow, including its operations and expenses and the debt repayment over the next 8 to 10 years?
Yeah, we have worked with the company to create projections that everyone feels. I mean, I like to do it as a medium, because sometimes you get clients, as you all well know, who think that the business is going to explode and 40% growth in 3 years and profitability increases and all your margins are improving. And sometimes you get clients who are very conservative, and that's how they approach their business. So sometimes you're trying to get a client to increase his or her, the CFO or CEO, whoever you're dealing with, to increase the projections. Sometimes you're trying to get them to slow down and be more realistic. But the idea is, let's get something that we feel comfortable and confident in. Then, as Steve pointed out, we do a lot of iterative modeling around that to create a transaction structure that we feel is fair to all parties, is sustainable to the company over the long term, and also is conservative enough that you can have a sensitivity analysis and you can see that you'll be able to repay your debt even if things go south for a bit. You'll be able to repay it earlier and reward people earlier if things do better than expected. But the idea really is that you're looking at the tail end of weeks of analysis and iterative modeling. So that's how we get to, for instance, the interest only for 3 years was part of cash coverage of debt and an analysis of that. It was an analysis of what happens to cash on the balance sheet, cash and non-cash expenses, the ESOP expense being non-cash, all those issues. And again, the reason, just flipping back a little bit higher level, the reason that you've got here a $25 million 100% transaction where 10 years ago you might have had a three bites, like 30, 51, and then 100% transaction, is because of if an ESOP is the 100%, has 100% of the stock of an S corporation, as you know, it doesn't pay federal corporate income taxes, and most states also follow that. So it essentially becomes a tax-free entity, freeing up a lot of cash, and so that's where the value really, and the cash coverage really becomes helpful. You'll also see that we do typically SARs and instruments like that that are synthetic equity, both as, the warrants we expect to be cashed out, the management SARs we expect to be cashed out, so that you don't disturb that tax strategy. So here's just sources and uses, 14 million and 11, you can see all that. In this case, we are using $25 million as the inside note. You don't necessarily have to have the inside note match the external financing. It certainly doesn't in terms of amortization schedule, because you want to spread that out so that you don't allocate all of your ESOP shares to participants up front, and then you're stuck with a compensation problem as new people are not eligible for an ESOP because there's nothing else being circulated. So you want to do that in a smart way, plus you also want to manage your repurchase liability over the long term, so you don't want to accelerate that unless you've got a good reason. So they don't match. They're two separate loans, and Steve will get into that a little bit more. So here, as we pointed out, there is a great deal of iterative analysis, and we're going to look at the ratios, we're going to look at coverage, we're going to look at leverage, and we're going to do iterative modeling to see, what's the most levered we can do this company that, we're comfortable with, how long can we stretch it out. And so in this case, the analysis of all the coverage ratios led me to assess a 3-year interest only on the seller note, and then we could easily amortize it over 5 years. There are a lot of ways to make those choices, and in this case, the amortization was there because of the cash flow. If it weren't there, then we might have pushed it back or even made it a bullet payment at the end of the term.
So this table that we're looking at is probably too small for most people to read, but what it's showing is the various years and the impact of the transaction on the company's finances over the time, right?
Right. This is just, the top line is cash. Essentially, you get the cash available to cover debt, and then you see how you're covering your senior debt, principal, and interest, how you see you're covering your subordinated debt, principal, and interest. So what you can do is manage senior debt, you can manage principal and interest separately, senior debt separately from subordinated debt. And again, it becomes a very iterative model so that you can come up with a strategy for managing debt that preserves the sustainability of the company over the long term, isn't going to push a company to the edge in terms of, real quickly having to meet their numbers, gives them the opportunity to hiccup and still meet their numbers, but it shows you exactly how close everything is. So if somebody is more aggressive or they have another reason that they can demonstrate that they want to leverage higher and they can sustain the company because they have another source of cash, or they can not take the note for a while or whatever, then you can increase the leverage up front. But in general, this is just the result of the analysis to say, how do we make sure and how do we understand the interrelationship between projected cash flow available for debt service and the various levels of debt service?
Thank you, Michael. Okay, so let's take a moment and just look at the structure of this transaction and how it actually works. You're probably all somewhat familiar with this diagram. Begins with the bank. The bank is going to lend, in this case, $14 million to the company. The company is then going to take that $14 million and use it to redeem all of the outstanding shares from the current owners, the sellers. Now, when we say all of the outstanding shares, there's a little asterisk that may be too small for you to read beneath the box that says company, which says that technically the company will redeem all but one share in the initial redemption transaction. And that is really a technical matter because we don't ever want there to be no shares outstanding. The company would sort of cease to exist, even if only for an instant. So in order to keep the company in existence, we leave one share outstanding, and the company will have the right to redeem that share after the ESOP transaction for a nominal amount. But there'll never be a time when there aren't actually any shares outstanding. So again, we start with the loan from the bank to the company of $14 million and the redemption by the company of the seller's stock for $25 million. And they pay that with the $14 million cash they borrowed from the bank and an $11 million note with a warrant attached to it that the company issues to the sellers. At the end of the day, the sellers are left holding the cash that we got from the bank, $14 million, and the note that the company issued for $11 million. So they have the total of $25 million and the warrants. Now the company has $25 million debt, 14 to the bank and 11 to the sellers. It in turn lends $25 million to the ESOP, and the ESOP uses that $25 million to acquire newly issued shares from the company. There are a couple of benefits to doing the transaction this way. One is that you can structure the two loans, that is the outside loan, partly from the bank and partly from the sellers, differently from the way you structure the inside loan. And more specifically, the outside loan is a commercial finance tool. You want to pay that off as quickly as possible. And particularly with respect to the portion provided by the bank, that loan is going to follow typical commercial loan terms. It'll have time for repayment, the interest rate, the covenants, and so forth. Events of default will all be what you would expect to see in a commercial loan. In contrast to that, the inside loan, the one that we've got diagrammed here, between the company and the ESOP, is not a commercial finance tool, it's an employee benefit tool. And that distinction is important because of how that inside loan gets repaid and the consequences of repaying that inside loan. Each year, the company is going to make a contribution to the ESOP. that puts money in the plan, and the plan uses that money to repay a portion of that inside loan. Now, when we started, all of the shares that the ESOP purchased were financed shares. None of them had actually been paid for in cash. They had all been paid for in debt. And therefore, the ESOP didn't allocate those shares to the accounts of plan participants. Rather, the ESOP held those shares in the ESOP suspense account, which means that they're owned by the ESOP, but they're not allocated to the account of any ESOP participant. As the inside loan gets repaid, a pro rata portion of those shares in the ESOP suspense account gets allocated out of the ESOP suspense account into the ESOP accounts of individual participants. And if that loan repayment is over 20 years, then it takes 20 years for those shares to get allocated.
Steve, is there an advantage to the company based on its limitations of how much it can contribute to changing the inside loan amount versus the external financing loans?
Well, sure. If the company is unable, based on its payroll, if the company cannot make contributions for the full, in this hypothetical, $25 million, the company could sell the shares to the ESOP for far less than that. It could sell it for $20 million or $5 million or even $1 million. As long as they're careful about how quickly they repay it, it can be any amount. The advantage of that is, some people feel that it reduces the fiduciary risk of the trustee buying shares because they're buying only for $1 million. Other people would say that the two transactions need to be viewed as a whole, and therefore there is no difference. But clearly, if you've got limited amount of compensation and your contributions to the plan are going to be limited to 25% of that eligible compensation, you do have more flexibility by using a lower inside purchase amount. The other advantage to using this two-step structure, that is the redemption of shares by the company and subsequent sale of new shares to the plan by the company, is that it allows a little more flexibility in the transaction design. For example, there are some questions about whether it's appropriate to have the ESOP pay an earnout to the sellers. That is, if the sellers feel that the company is really worth $25 million, but the current finances show that it might be worth something less than that, nonetheless, the sellers feel very strongly that the future finances will achieve that higher value. In non-ESOP transactions, the transaction will often be structured so that the amount paid at the closing is the amount that the purchasers feel comfortable is represented by the historic numbers, but the sellers have the opportunity to get an additional payment after the closing if they achieve their forecasted numbers. That's called an earnout. There's some question whether an ESOP can pay an earnout. There's no question that the company can pay an earnout. So by using this structure where the company redeems shares from the sellers, that portion of the transaction could include an earnout. The company would then sell shares to the ESOP. That portion of the transaction would not. And yet, the ESOP is benefiting from the terms that the company negotiated, since it ends up as the sole shareholder of the stock.
Thank you. Now we're just going to get into how to assess an estimate for the value of a company for a client. Again, part of the issue here is that an ESOP trustee will have, as you know, his or her own independent financial advisor to do an analysis of what they think the company is worth. And we're not trying to reproduce that. We're not trying to create a certified appraisal in our analysis. What we're trying to do is give our client, the seller in this case, a fair idea of what the company is worth, what the equity of the company would be worth in an ESOP transaction. So we have to explain often to clients that an ESOP trustee can pay only as a financial buyer, that they essentially are purchasing the future cash flows of the company rather than including the strategic value of potential changes or technologies or whatever. That's why when a company is purchased in a strategic acquisition, the prices are higher because they're buying for the fact that 1 + 1 can equal more than 2 in that instance. They may be buying a particular technology or product. They may be buying a brand or goodwill. There are other opportunities that are represented in the strategic sale, but a financial sale is the cash, pure and simple. It's the dollar numbers and the projections. So that's what we do for our client. But again, this is a transaction so that at any point it is a negotiation between buyer and seller. There are a number of different approaches to take in evaluation. So there's assets, which is usually better in different kinds, depends on the company. But in general, the two used most are comparables, to look at publicly traded or transactions that you can get a hold of in databases to see what kind of multiples, EBITDA multiples or other multiples, are trading at in that industry, and trying to match the company to the closest multiples and then see how the comparisons work. Discounted cash flow is projecting what the future performance of the company will be in terms of cash that will be available to the buyer. And there's a standard financial analysis approach with a discount rate that is generally a build-up. If you're familiar with the CAPM model, basically you start with risk-free, and then for each level of risk that you add, so when you go from U.S. Treasuries, for instance, to equities, you have an increase in risk and you have to reward for that increase. Then when you go to smaller companies, you may have that, and then you may have idiosyncratic additions to risk by an individual company. And so you add up all those layers and you get to what you consider a reasonable discount of future cash flows. As they told us in B school that cash is king and cash is the most important thing, they also told us that $1 in 3 years is not worth the same as $1 today. So that's what you're doing, is saying, in 5 years the company is projecting this kind of returns are going to be consistent, but that's in 5 years, so what would I need now in order to feel comfortable that I'm paying the correct amount for that future cash flow? So there are other approaches. We tend toward using these two. They're most reproducible, and they're more universal than, say, the asset analysis, which can often be used for, if you've got an asset-rich company, you may find that the asset analysis shows, for instance, that the company is worth more dead than alive, which leads you to interesting recommendations to your client. So here's just a quick sample of comparables analysis. So we just looked for, in a particular company, if we were in this industry, we'd look at these kinds of companies. We'd get a sense of what the last 12 months were, what the current price is, market capitalization. So we settled on these 4 companies, which we consider similar to this fictional company that we've created here. And this is very helpful because now we're looking at how are they trading. And so it gives us a sense of the highs and lows, the differences, the medians, and how relevant they are to the company that we are actually looking at. So if there is a consistency, if it matches the company that we have, then these public comparables become much more useful, and then we will track how the revenue that's going to be produced by the subject company, the EBITDA that's projected for the subject company, or the last 12 months, last fiscal year, how that all compares and what kind of value estimate that would provide. And so depending on how strong a correlation there is, we will incorporate more and more of this information into our analysis of what the cost is. Income capitalization, again, we talked about discounted cash flow. You can go backwards or forwards depending on what the company is. You can just capitalize previous cash flow if it's a consistent company that pretty much produces the same every year. You know, that's one approach, or you can create projections and do a discounted cash flow of future value. So you're either, in income capitalization, you're either discounting past performance or you're discounting future projected performance. This is a DCF analysis, so we're projecting forward in this case. We're incorporating all the various elements that you need to have here. You need to understand the tax rates. You need to understand what kind of future projections you're going to have in the out years. And you decide sort of how far out makes sense to project. If you project next year, you can look smart. If you really believe your projection's 5 years out, then those are going to be very, very impressive projections if they come true. I mean, the farther out you are, as you know, the less likely it is to be accurate one way or the other. The only thing you really do know, absolutely, is that your 5-year projection will be wrong. So, again, that's why the further out you get in projecting cash flow, the discount rate is essentially exponential, and so money in 5 years is worth less than money in 3 years is worth less than money tomorrow. So what this does is it goes down, it takes your cash available, it takes out the expenses that you need to have, taxes as a standard model, other issues, and then it discounts the amount that's left. And if you've ever seen DCF models, then you have here a perpetuity amount, which basically takes care of all these years going out here. So that little number right there is essentially giving you the value of all of these projections going out into infinity. It's always fun to think about these things lasting forever. Thank you. Okay, the next slide. You want to do a sensitivity analysis on all of this stuff, and you've seen some of, an understanding of the iterative process here in modeling and being particularly cautious and attentive to cash coverage issues, to long-term sustainability issues, to being realistic in projections and profitability and margins. And so we've done all that, and we've built from the bottom, and it's really helpful, frankly, to build from the tiniest pieces of these things, because those are the things that the client knows the most about and you can learn the most about. And so then when you build all of these projections and modeling on top of it, you know that you've started from a very substantial base of analysis before you start adding projections and futures to it. In this case, what you have is in the middle, you'll see that dark number. That's essentially the capital, weighted average cost of capital on the top. In this case, we said it was fairly low at 14.5 for this company, and a 3% long-term growth rate in perpetuity. And those are sort of the standards for this, and that's where we ended up saying that the operating entity is worth $29.8 million roughly, and then you subtract debt. This is minority value, so if it were publicly traded, then you subtract debt, you add non-operating assets, and you have discounts for lack of marketability and a premium for control. So you do all of that. Sorry to race through that. We'll get to that next. But here's the core value of the operations, the cash that's going forward. Now this is taking what we were just talking about, which is, in this case, we considered that the comparables just weren't applicable enough. They were either too spread out or didn't really fit this particular company. It was different from the industries out there, or the size differentials just made all the margins different. Whatever reason, we gave this a weighting of 0 in this case. That's not always, that's just in this case. So we're doing this whole valuation based upon discounted cash flow. So what you have is that operating number that we just saw. Here's the value of the operations. Then you've got additions. You've got cash on the balance sheet that's not needed for operations. You've got non-operating assets. And down here, for instance, you've got debt that you're subtracting, because the value, if you remember an earlier slide, the enterprise value is the debt plus the equity. So once you've created the enterprise value, you need to subtract the debt so that you have the remaining value of the equity of the company. So here's a minority position. As we talked about, we're selling 100%, so it becomes a control premium comes here. So here is what we would come up with as control marketable value of equity, but there's a marketability discount in this because it's a private company and it's more difficult to sell, so you have to account for that. In an ESOP, the marketability discount tends to be significantly lower than in a typical private sector transaction because the ESOP shares have a put option, and so the company will buy them back. So the risks of finding a buyer are significantly lower than the risks of finding a buyer for a typical privately held company. Here's how we determined, we talked earlier about the CAPM buildup and the capital asset pricing model buildup. Here are some of the inputs for that, the tax rates, things like that. But you really start with the risk-free rate of return. Then you have a market premium because now you're going to the market from risk. Then you're talking about a small stock. And then below you're talking about what's different about this company. So all these little red things are my notes about where that came from. So the tax rate was built based upon their company, their industry, their state, and the federal taxes. The risk-free rate of return, this is an old one. That would have the date that was taken from treasuries and which treasury issue. The market rate premiums, all that stuff tends to come from Ibbotson and Company, which is sort of the center of the known universe. And Roger's a very nice guy, by the way. He was one of my professors. In fact, he leased me an apartment for a summer job. But that's how you do the capital asset build-up to get the weighted average cost of capital. So we used, in this case, comparables. We used our analysis and built up that discount rate. And that discount rate is important because, as you saw in the sensitivity analysis, that's where this discount rate is, right there, that we used. And so you want to see if you had a higher discount rate, you'd have a lower value. If you have a lower discount rate, you have a higher value because it's all a measure, an inverse measure of risk. This is what we do next, because what you're looking for, you've got warrants attached to the seller note. So the seller note has an interest rate of 2.5%, which is not something that you're going to find repeatable in any marketplace, really. And so the warrants attached to it to get you to a reasonable rate of return. I apologize for the size of this, but this is a fairly complex piece of modeling around two things. The performance of the company, past, present, and projected, its balance sheet, its financial statements, its cash flow, all of those issues, plus the Black-Scholes model which is the standard method to value an option. And a warrant is an option to buy stock. The only real difference is the warrant is generally attached to a debt instrument, but it's an option to buy stock in the future.
So, Michael, I'm fairly certain that none of the participants in this presentation can read the detailed analysis there, but on a conceptual level, it seems to me that if I'm the seller, I'm selling 100% of the company. One of the advantages of this warrant is not only that I'm going to receive more in total, but that I get to keep a piece of the upside of the business, because so many of my clients are hesitant to sell and make that final decision to step out of the ownership position because they think that the future is brighter than is reasonable to forecast. So this allows them to keep a piece of that future and benefit from it if it is accomplished, and at the same time it's not hurting the company or costing the company anything if they don't accomplish it.
Yeah, that's absolutely the case, and one way to look at this is that you've got a group of sellers who have a choice of instruments that they're going to invest in. So they're currently invested in equity of this company, and based upon its returns, they can choose to trade that for cash plus a piece, as Stephen pointed out, a piece of the upside. So what you'll find is that clients who really have a sense that the business is going to keep growing are much more interested in the warrants, and clients who either want to get out for some reason, don't want to be involved in the business, or have some, concerns of their own, will want to maximize cash up front at the transaction.
Let me just share what I think is a rather interesting and imaginative structure on a transaction that we closed in December. We had a company owned by two families. One principal who was truly retiring, wanted to go to the beach, leave the state, no longer work at all, and the other principal who had already transferred some of his stock to his two sons, who he was active and both of his sons were active in the business. We set up a transaction where there was some bank financing, and all of that cash went to pay the first principal. Let's call him Ben. Ben got some cash, and so the bank got a senior note in exchange for the cash they provided, and then Ben got a senior subordinated note for the balance of his purchase price. Senior meaning that he came before the other sellers, but subordinated to the bank. The other family, let's call that principal Bob, he got his entire purchase price in a junior subordinated note. So the order of priorities and payments were that Ben and Bob both got interest only while the bank was being paid. Then Bob got interest only while Ben was being paid. And Ben got paid out, or Ben will be paid out in full, and then Bob will get paid out. And in exchange for that delay in timing and subordination in risk, Bob got all of the warrant. Ben got a moderate interest rate, slightly above what the bank is getting. And Bob took this low cash coupon, but a significant warrant, so that he's going to really benefit from his work and his son's work in building the company in the future. And that's one of the great things about an ESOP transaction, is you can really structure it to suit your particular unique circumstances. I don't know of any other transaction structure that allows that much flexibility.
Yeah, so Ben got essentially traded his stock for cash, or more cash sooner, and Bob got to continue to run the business and have his family in the business and make it grow. We have another client we're working on right now, in which there are a large number of shareholders, and the interesting business opportunity is for management, senior management, to figure out how they want to provide golden handcuffs using some of the seller financing. So there are a lot of different opportunities of how you can structure this and how you can manage the transaction itself to achieve business goals.
Yeah. One other piece one other tool in the toolkit that plan sponsors have available is a management incentive plan. Now keep in mind that the ESOP is governed by ERISA, and as a qualified plan, ERISA requires that the benefits be shared among all eligible participants according to formulas created under ERISA. And generally, the most common formula, almost universally, is that shares are allocated in proportion to each eligible employee's eligible compensation. And that is basically their W-2 income up to a certain limit. Right now it's around a little over $250,000 a year. But there are typically a small group of key managers or key salespeople, key employees that the owners are concerned need more and are entitled to more, that they want to give more, and they don't know necessarily how to do it within the ESOP. So one way to accomplish that is to use a non-qualified plan alongside the ESOP. That non-qualified plan can take many forms, but the most common is what we call a stock appreciation rights, or a SAR plan. The SAR, stock appreciation right, essentially is a contract between the company and an employee to pay the employee a bonus in cash. The amount of the bonus is based, calculated upon the value of the stock, or really the change in value of the stock from the time the SAR is granted until the maturity date of the SAR. And it's very flexible. The amount of the percentage of equity of the company covered by SARs needs to be negotiated with the trustee at the time of the transaction, because some SARs are dilutive to the equity of the company, some are not. So the terms need to be carefully planned and understood by the sponsor, by the management team, and by the trustee, and all made part of the initial transaction analysis and negotiation, and of course the documentation. But this lends one more tool to the flexibility available to the sponsor to transfer all of the ownership to the ESOP, allocate that ownership in accordance with ERISA, and still provide the kind of management benefits and flexibility that entrepreneurs are used to using to drive success. And that brings us to your questions, if you have any. And if you'd rather not type them, we can open up your voice line. We've muted them just so that there wouldn't be too much noise on the line. But if you send us a chat message that you have a question, we can open up your voice line. No questions.
Have we been that clear or that confusing?
Well, thank you very much for your time. There will be a download available, though it will be somewhat redacted. Wait a minute, we do have a question. How can the seller retain operating control after the ESOP sale? Excellent question, thank you. There are several ways. You know, one of the important things that Michael pointed out in the valuation here is that the price paid included a control premium. So in one sense, the sellers are giving up control. However, some very important caveats to that. first is that as long as the loan is outstanding, there can be covenants regarding control, regarding positions on the board of directors, and so forth. So as a contractual matter, the sellers can retain a significant amount of control until the debt has been repaid in full. Beyond that, as a corporate governance matter, they can retain control in a couple of other ways. One is because the board of directors, not the shareholders, manages the company. And the ESOP is a shareholder. The ESOP elects members of the board of directors, but it's the board of directors who control the day-to-day, week-to-week, and month-to-month operations of the company. As you know, if you own shares in a public company, the questions upon which you are asked your opinion are very few and far between. Well, it is state law that controls what questions the ESOP has a say in, or any shareholder has a say in, and that state law applies to the ESOP as a shareholder as well. The third is perhaps, I think, the most important, although to a concerned business owner, it initially, I think, is the least compelling, but once you really understand the ESOP, it's probably switches and becomes the most compelling. And that is that the ESOP is a financial investor. The ESOP has neither the desire nor the ability to run a car dealership or a supermarket or an architectural firm or an insurance brokerage or any of the diverse and numerous companies that an experienced ESOP trustee gets involved with. So they don't want to run that company. And in fact, if they mismanage their role, they can have personal liability for the losses to the ESOP that result from that mismanagement. So who are they going to elect to manage the company? Chances are very strong that without any of these other contractual restrictions or corporate governance restrictions that I've touched upon, that they want the same people who built up that company to a value at which they were willing to buy it, they want those people to continue running it, because those are the people who know how to make it successful. That's a pretty quick answer, and there's a lot more detail to it, but I think it sort of gives some reassurance. Next question we have is, how do you manage the repurchase liability? The first way you manage it is by knowing that it exists, and I thank you for that question. Repurchase liability is the obligation of the company to create a market for the stock when somebody is entitled to a distribution from their ESOP account. The company can either purchase the stock itself, or it can contribute money to the ESOP and cause the ESOP to purchase the stock. In either case, the repurchase liability is a small issue when the ESOP is first created, because the number of shares that have been released from the suspense account is small. The number of shares that are vested if somebody leaves is a small percentage of the shares that have been released. And the value of the company is depressed because of the debt that the company has undertaken in the transaction. In addition to that, the ESOP rules and most ESOP plans allow the company to defer many of these distributions during the time the debt is being repaid. So repurchase obligation really becomes an issue as time goes on, and if you haven't done a repurchase study as part of your initial analysis or shortly after the transaction, then when you're 2-3 years into the loan, you really should do a repurchase analysis, so you'll have an expectation of what your likely repurchase obligations will be. And then there are a number of ways of providing financing for that, either through contributions in cash to the ESOP that are held within the plan in cash, creation of a sinking fund within the company, purchase of life insurance, which covers the company only in the event of the death of a participant, There are a number of solutions, and each of them has their own costs and benefits. Typically, the best answer is a combination of different solutions to reduce risk and cost in a variety of different scenarios. But I guess the most important thing in response to the person who asked the question is that you're thinking about it and you're aware of it. So just the fact that you're asking the question indicates to me that you're already well on the way to managing it.
Right, and SES will often work with clients to do various levels of analysis, everything from just preliminary all the way through structuring, a long-term plan to manage the cash issues within the context of business goals.
Any other questions? Well, thank you for your time and attention. If you have other questions, please feel free to contact Michael or me. You will be able to listen to a recording of this, or if there's anyone else in your organization that you'd like to share it with, they can listen to it and view it on our website. And we will, within the next day or two, provide a redacted version of the presentation for download. Thank you again, and hope you'll join us in the future. We're signing.
Premiumbeat.com